this is the place where you realize what is the real market mood right now. I've come to this dealing room in May 2014, and that time there was excitement and euphoria. Right now there is gloom, doom, and a lot of fear. So what a difference, Mr. Aggarwal. I guess 18 months can change. Last time
Welcome
I was.
To new dealing room. This is a brand new dealing room.
This is
the biggest,
And I mean, it's always exciting when I come here.
Yeah.
I'm sure these are difficult days for your dealers as well. The mood is outright bearish.
Yeah, I mean, the dealers, for them, for dealers, it doesn't make that much difference, but the pain in the client's accounts and their psyche, that impacts the mood here, and so whenever there is a volatility, business is good because there is a lot of buying and selling, but the mood is somewhat, depressed because of the losses in the client's accounts. That's the kind of ruling, what do you call, mood right now here.
Everybody is talking about the 3 C's: China, currency, and commodity.
Wow.
Yeah, that's the latest one. 3 C's. Which is the bigger C according to you? Is it China? Is it commodity? Is it currency?
See, I mean, commodity we have seen. I mean, that has been the biggest collapse of oil, and commodities have happened even earlier. But the collapse of oil and the collapse of commodity, these are things which we have seen, and it impacts the corporate side of it. Currency is something which is very opaque, and I mean, I don't have any understanding of it, but obviously it is happening. So it's an entire global macro which is coming together, and nothing seems to be right at this juncture. And when one edifice of oil collapses, I think it takes a lot of other constituencies, whether it is the interest rate, whether it is currency, some countries here and there. Then simultaneously even US is trying to unwind. So I mean, you can't make head or tail what is going to happen, how. So there's a lot of stuffs moving at this juncture. Not only oil, then the unwinding of US stimulus they had done. Then China is trying to move from investment-based economy to consumer-based economy, and hence they have issue about their own debts level. So China is actually very strong. They had $600 billion of current account surplus trade surplus last year. So I don't think China is that big a concern as much as it is made out to be. But I mean, other issues are seriously large. I mean, particularly collapse of oil. It's almost a $4-5 trillion collapse. So it's not small.
So let's understand all those issues one by one, and then we'll talk about what should one do, because I mean markets are falling. Now you have to look forward. There's no point in doing a backward analysis.
No, since we got into that triple C, I said So
now,
what are limited?
Whatever is creating chaos in this kind of an environment is not new. China slowing down, 2015 data. Oil had already fallen in 2015, and again the chaos in currency is something which we've reported as journalists in 2015 and as fund managers, as investors, we've observed in 2015. So what is new about it? There's nothing new, yet markets are in a panic mode.
So since markets all over the world, they're aligned. So best thing might be happening in India for its own economy. Current account is deficit down to almost 0 or 0.5% or something like that. The government of India is first time solvent, and our subsidies are out. Growth is supposed to be one of the highest in the world, 7.5%. So everything is right for India. Yet the mood, I mean, for the first time, when Indian story is right, everybody is saying India is singled out in the whole story. But this is a time when FIs are actually going out. So that linkage with the world economy, particularly the world stock market and our stock market, is what is actually the main concern here. So when Mr. Modi came in 2 years back, index was exactly 7,200. We are standing exactly there. Oil was at $110. Today oil is $30. Can't ask for more. So clearly earnings have grown of some of the companies at least, if not all. So clearly this is a market which should have been stronger, fundamentally should have been stronger than what it was 2 years back. But today we are standing there only. So, and there is a lot of fear on the street. So as Buffett says, when others are fearful, you should be greedy, and you should be fearful when others are fearful. So right now clearly fear is there. I mean, you can see the actual word fear all over.
So are you greedy right now?
Yes, I mean, unfortunately I don't have enough money to buy because I don't give a cash call. But whatever money is coming, we are just deploying it right now. Like if 9 o'clock money comes, 9:30 I'll buy stuff. So this is a great time to buy. Only time will tell how great it was.
Of course.
I cannot say that whether markets will fall, not fall by another 200, 300 points or maybe 1000 points. I don't know. But clearly, I don't understand the market, and never I have been right in saying where the market is headed in the short term, particularly in the short term, because short-term markets are completely irrational.
They are an emotional beast.
Yeah. No, it is irrational. The simple word. I'm telling you, it is insane. What can happen in the market? Individually stock, what can happen in best of the stocks. So one day Reliance can be up 5% and very second day with best of the result it can be 5% down. I mean, one can explain why it has happened, but market can be that irrational. So the issue is that you cannot rationalize what is an irrational movement. Okay, what is going to happen in 10 days or 15 days. You cannot rationalize. That is, I am not in good.
2017 we'll figure out where the market bottom is. I mean,
yes.
It's only 1 year.
So as it is said, bottoms are made for fools and liars. Are we getting, see, we are not buying markets, we are buying stocks. Are we getting stocks cheap?
Are you getting stocks cheap?
Yes, whatever we want, we are getting at 30, 40, 50% lower than wherever they were. And after announcement of few results. So, say like this quarterly results will be on. This quarterly result.
numbers are strong, Asian Paints numbers are strong, Infosys numbers are strong.
So whatever one likes, after seeing everything, you can buy 20%, 30% cheaper. It is across the market, it is 20% cheaper. So what more can you ask for? So the people, see, there are two types of people. One who are in the market and they can deploy some more. Second, in India, 99% people have yet not come to the market. They can't ask for more. This is the best time to start entering the market.
So for those, when I don't want to get this one wrong for the benefit of our viewers, for those who believe they're genuine long-term investors, if they are in here for 2 years, 3 years, 5 years, this is good time as any to start deploying money into equities.
Absolutely, without any doubt. Because see, long-term rate of return of this market is upwards of 16%, plus 1.5% of dividend. So 7.5% has been 34 years history. I can't believe the next 25, 10, 20 years will be very different, if not better.
But are valuations really on our side? I was looking at some data points which indicate that India is trading at a premium to other emerging markets. Small and mid-cap stocks are trading at a premium to large-cap stocks.
Yeah, so it's like, it's like stocks. I mean, Hindustan Lever will always be 40, 50p. But the index will be at 18 or 17p. So there will be a difference. India and Pakistan you cannot compare.
Of course.
Or India or Indonesia you cannot compare. The opportunities here, the quality of companies here, the kind of governance we have. It's a continent, it's not a country. I mean, anything you make, I mean, you can make 10 million bikes under one brand. You can sell 1 million tons of biscuit under one brand. This is possible only in India.
So George Soros is of the view that there are echoes of 2008 which are being felt according to him. Howard Marks is saying that the pendulum of investor sentiment has shifted from extreme optimism to extreme greed now. What is the third great investor standing in front of me saying? Let me hear it out from you.
Yeah, so I also heard, I think George Soros is a wise man. He knows.
Everybody has an opinion.
So they have global opinion. Thankfully, we are only looking at Indian stocks. We are not bothered so much about this thing, and we can take 10-15% downside also. In the sense that if you buy today at 100 rupees and if it goes to 95, I think the world is not coming to an end. We are buying for 2, 3 years, 4 years, and if you actually cannot take 5-10% volatility or downside loss from your current purchase price, I don't think you should come to the market. You should be very clear. I mean, you cannot buy at the lowest price.
So the businesses you track.
Yeah. So what I'm saying is that businesses we track, they are in sound footing. Selectively, whatever I buy, and we look for quality and growth. Quality completely uncompromised in the sense that quality of business, quality of money are top class. Growth minimum 20-25%. Now you say, where do you get 20-25% growth? I need only 15 companies, and there are at least 100 companies which are growing upwards of 25-30%, large sizes I'm saying.
Okay. Now, a couple of reboots have happened in the world. One reboot is commodity prices are down. Second reboot is interest rates will come down. Third reboot is government spending is likely to move up. So let's understand these reboots. Because of decline in commodity and oil, autos will benefit, consumer spending will benefit. So do you think that should be the anchor part of the portfolio?
See, when you make portfolio, you talk about 18-20 stocks, and we are fully invested. So where exactly is the current allocation? So current allocation are in say automotive, consumers, IT, pharma, then some specific opportunity stocks, aviation. So all these, so that's how it makes up for 18 stocks. Now, what happens is every 3-4 months, you get one wonderful opportunity, compelling opportunity in IPO or something changes and you get that opportunity. You meet somewhere, new story develops, then you throw out one matured stock and buy a new one. So that's how the portfolio is being managed. It's not that today you suddenly you pick up 18 stocks from the market. That's not the challenge for me. I would urge the new investors before they dabble into stock picking. They should avoid stock picking. First, they should buy high quality mutual funds, buy managers, and then when they think that they're confident, they've learned enough and they have enough experience of stock picking, then they should.
I'll just tell when we discuss this on public forums, even on ET NOW, I always urge viewers that you would find quality managers which are available to you at about 2% cost. You can pick and choose in the gambit. One of the finest money managers is standing with me, but that's our viewers' choice whom they endorse.
My interest is only one, that people should make money, because very few people make money in the stock market. Because a lot of people lose money and some people make money. And a lot of people lose money, they are all traders. Okay? So the traders, they subsidize the investors. And investors make tons of money.
You should invest in stock, never rent in stocks, like we say. Okay, I'm going to change the scope of the conversation and get into something which is referred to the most important benchmark for an investor, the margin of safety. What is the margin of safety for a long-term investor in this market after the recent correction?
So margin of safety, if he had bought at say 8,000 or 8,500, today his margin of safety is 15% more. I mean, everything being same, his purchase price is today lower by 10 to 15%. And across the board I'm saying, but specific stock will be 30-40% also cheaper. So the margin of safety is bigger for sure between 2 months back and today. But real margin of safety is in what you buy, and that is in the mind of head of the investor.
Where are you confident of the long-term trends? You always believe in buying big trends,
yes,
and then you look at stocks within those big trends. So what are the 2 or 3 large big trends you're confident about?
So one of the things is that what we are passing through, out of those 3 C's, there's commodity and oil. This collapse of oil is a very big thing. I mean, it took 15 years or 12 years for the commodity to go 5x from $25 to $125.
And 2 years to collapse.
And just in less than 2 years, it is collapsed to now, actually $25, $27 again. And people are saying, predicting even lower rates. I don't bother about them, but what I'm saying is you are at those kind of situations. Now, there are a whole lot of companies, entire system was designed for $110. Even today, we are running almost $100, $110 economy. So there is going to be a huge benefit of this particular thing. 10 years of atrocity, I'm just using a harsh word, atrocity of oil, is going to be, not be over just in 6 months or 8 months. Unless the oil you think is going to go back to $100 next quarter. So I don't think that is going to happen. The thing is that it is going to be very low for a very long time. That's the new terminology. Very low for a very long time. So if that is so, if it is 4-5 years of sub $50, in that case, you have to look at a lot of industries very differently.
So aviation is one, paints is one, autos is one.
There will be lots of them. There is a lot of packaging materials. All the packaging materials are down by 30-40%. And hence, the businesses which use a lot of packaging materials, they don't have to pass on. Say even a biscuit. In biscuit, you need 7-8%, 10% packaging cost. That is down by...
So why commodity consumers? That's a very basic...
No, it's not that simple. You have the level 1, then level 2, then, logistic costs can come down. Then, so you have to look at company-wise company. Company by company you have to look at it. See, what happens is like in aviation. One is the cost side. Second is the lower ticket price just booms the number of people who want to fly.
But whatever you're buying, you're sticking to market leaders, whether it's aviation, whether it's two-wheelers.
So you have to buy quality, you have to buy market leaders, you have to buy companies with huge moat, competitive advantages. And buying quality is like buying, riding a high quality boat. In the boat, so you will not sink. The quality boat will allow you not to sink. But you don't want to sink, you want to go through the river or you want to cross the lake. For that, you need the overboard motor.
Now, what has worked in last 3 years is quality at any price.
Yeah.
Whether it's a Nestle or a Page Industries, P multiples are way higher than what you actually want them. Can quality work now?
Quality will always work.
Okay.
But it is not about the quality. Only quality is a quality trap. If you buy only quality and sit there, it is not going to make money. You need quality and growth. Because that's what I was saying. The boat is the quality, but you need the overboard, that motor. The larger the motor, faster will be your boat moving. So you need growth. Higher the growth rate with the quality, you'll make faster money. So the issue is that a lot of people, they get trapped into buying very high quality franchise. So that has to be avoided in a sense actually.
Okay.
So you need to buy QG.
Quality and growth.
Quality and growth at reasonable price. See, you cannot buy at any price anything.
Of course. Quality and growth at a reasonable price.
Yeah, that's the call.
But in this market, Mayam, broadly, I mean, since you manage public money, your portfolio is out in the open. Your positioning has not changed, and it's unlikely to change.
It will not change. It will not change. That's the promise. Good time, bad time. We will stick to our investment principles. That's the only thing which will see us through. If you change midway, you are going to be, a market will, I mean, because market job is to challenge your determination. And if you shake from your determination, market has won.
Okay. Now, let's talk about pharmaceuticals. You do have some pharma stocks in your portfolio. I am worried about the disruption happening in that space. When I say disruption, US FDA is scanning through all pharma
That's
companies.
the regulatory stuff. I mean, it was always
global pricing power, global generic prices have also come down. US market is the mainstay for Indian pharma companies. Do you think what's happening in the pharma space is just a business cycle adjustment or disruption?
No, it's a company-specific issue, but I think the opportunity size is massive. I mean, the world needs more and more pharmaceuticals, more and more patents are going off. So the opportunity size, the number of molecules which are available for generics, kind of branded generics or generics production are increasing, and more, I mean, as the world is becoming prosperous, as a whole the world is becoming prosperous. So they will need more and more medicine, and it's aging also. So medicine growth of say 7-8%, 10% all over the world is going to be continuous. The issue is that competitive advantage of India. It's like technology.
Do you think it's there?
It's huge. There is no country which can challenge India.
So the top 5 or 6 pharma companies, do you think they will be higher and bigger in the next 5 years?
Beyond doubt. I don't have any doubts. And right now, Sun Pharma might be 5 or 6 number in the global ranking of generics. I mean, we have a good chance of making it the top 3. I mean, not Sun only, but other companies which are coming from behind. Other companies, they have aspiration to become Sun. Sun has aspiration to become Teva or whatever. So I think this journey is going to be on. And it's not a, probably the story can be as exciting as tech. Tech is much bigger canvas, but...
tech is one where numbers have been strong. TCS, okay, business is contracting, but they're still growing. Infosys, the business is actually expanding now. HCL Tech margins at 20%, still a cash generating machine.
Both are massive global opportunities. And it's not 1 quarter or 1 year kind of a game. It's if you look at, see, in 2000, we were doing $5 billion out of $500 billion globally. We were 1%. Today, we are doing 100 billion out of $1 trillion. In 2025, when it will be 2 trillion, we might be doing 300 to 400 billion. That's the game.
So stick to large cap IT again?
Yeah, of course. I mean, large cap growing IT. I mean, like, I believe I was reading somewhere, Cognizant last year did growth of about $2.14 billion, which was equivalent to all 3 put together. It's a message to them. It is a message to Infosys. It's a message to
what I'm trying to understand from you is that the technology world is changing. There is a change in shift in terms of technology delivery now. Everything is going digital. Everything is going.
That's an opportunity for us.
Model. So when the reboot will happen, who will become the winner?
Who's going to do it? No. Who's going to do it? It is. See, I have an IT need. This firm has IT need. I have a relationship with one IT company. So whatever changes I want in my requirement, it will all be coming from them mostly, unless except for very few. Very specialized stuff. So these guys only are going to provide all the digitization.
No, so again, just for the benefit of our viewers, when a reboot happens in a technology, there are gainers and there are losers. Do you think once the reboot will happen, or the shift which is undergoing right now, will large cap IT companies emerge as winners, or disruption will happen within the mid cap IT companies?
It looks still the large caps have the edge in the race, but it doesn't stop any maverick mid-sized company to come from behind and become big. Say like Tech Mahindra was very small 3 years back. They acquired Satyam, and they have now become in the big 5 or 6. So like that, there is still an opportunity for $1 billion kind of IT companies, or you have a very specialized product. But I think for the larger relationships, it is the large companies.
you've seen such market conditions before.
Yeah.
What is your insight? If you have to calm your unit holders and our viewers down, how would you like to connect history and how would you like to connect these panic times for us?
Yeah, so this is part of the deal. I mean, this is the risk when we say equity markets are risky. So now risk is standing right in front of you. When markets are rising 9,000, 9,500, that time risk is only a caution statement. But today risk is facing you. But this is what happens. This is the risky part of it. You have to sit tight. You have to sit tight now. So you don't have to, this is the nature of the market. Market will fluctuate. It is fluctuating right now violently. So you have to show your determination that the businesses you have bought, there is nothing happening to that. Today HDFC Bank is going to make as much money as they made 2 years back or probably double of that. So I don't think there is any impact in the amount of money being made by most of your businesses. Probably they are making more money. So what we have to see is, we have to focus on the businesses, the companies which we have bought, and don't bother too much about the fluctuating prices. And if you have more money and you can buy it 30-40% cheaper, please add on to your existing stocks more.
Why are banks getting corrected as if there is no tomorrow? Banks are a proxy to economy.
Yeah.
If your numbers are correct, if the general belief is correct that the best for Indian economy is yet to come,
obviously,
then banks should be in a sweet spot. Banks are, people are throwing away banks as if there is a systematic failure.
Yeah, so banks are always, punished or they go down for their bad underwriting of loans. Okay, and we know a lot of this infrastructure and commodity companies loans, power sector and then steel sector, all those loans are riding in the books and they have not been fully taken care of. So there is a lot of these banks, they are suffering because of the fear of how much is there. And till it is declared and recognized, I think it will be very nice to explicitly declare and do whatever.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.